All right, we're live with Dimitri from Pantheon Insights. He was on recently, and everybody wanted to see Dimitri again. We had a great conversation about geopolitics, and you guys know it's one of my favorite things to cover as well. So Dimitri's on here. We're going to talk to him today about a couple things. He just put out a tweet a little bit ago. If you guys follow his page, man, he's got a bunch of stuff on there. It's at Zablin Dimitri. Zabelin. You guys can see his name there. So basically take his name, put the last name first, Dimitri second, and you got his Twitter handle. And he's got, we're going to have a conversation on Fed rate cuts. We're going to have meme asset pricing surging, US GDP, inflation, consumers. And he says the consumer is cracking, which I also agree with. And the S&P 500 only down 1% from all-time high. So we're going to cover all that today. So how are you doing today, Dimitri?
Yeah, 100%. Yeah, well, Jason, thanks for having me on. It's a pleasure to be here. I mean, what a Monday to start off with, right? Roaring Kitty makes a resurgence, it seems, and then GameStop is up. The part for me that I think is very weird, and you know me, like I'm not a short-term investor, which is nothing bad. You know, I'm just more of a long-term macro trader, and particularly like more so now thematic investing. What I think is really kind of concerning for me now is before, you know, the recent CPI print, and really at the beginning of this year, end of last year, you saw this and everybody else. It seems that markets were going higher and higher, and I kept saying macroeconomically this doesn't seem to make much sense until you started looking at the consumer. But something that I started to look at was, okay, well, what's the story that's driving markets higher? And the story was built on three pillars. We're getting rate cuts, unemployment is falling, and inflation is falling. I mean, what a bullish story. I mean, it really can't get much better than that. So why wouldn't markets rise on that story? It's very compelling. But now all three of those pillars are now beginning to show some cracks. And therefore, the foundation for what has sustained the market rally could therefore be a more precarious than we care to admit. So let's look at some of those three pillars. The economy is strong. US GDP came in recently in what was it, 1.6%? Yep. Inflation came in hotter than expected. If memory serves, it was 3.8 versus 3.6, which may not seem like a big deal, but you have to remember that 2% is their goal. They're technically almost already 200% higher than what it actually should be, right? It should be at 2% as per their mandate. And then the third one, which is rate cuts. We're not seeing as many bets indicating that we're going to get easing of credit conditions through that particular lever. You obviously have the balance sheet and you have quantitative easing, you know, and you know, Fed rhetoric, which, you know, other more indirect levers. But as far as like direct lowering interest rates go, as far as I understand it, the Fed rate cut bets have fallen quite a bit. So now you have to ask, what is the story that's driving markets higher if the hopes that were sustaining it now seem a little bit more precarious, right? If we look at, for instance, the consumer, right? We were talking about the resilient consumer. Don't bet against the consumer. Sure, that's true. But what sort of piqued my suspicion was when I began to see headlines saying that people are withdrawing from their 401ks at near record levels and credit card debt was surging in order to pay off their bills or maintain their lifestyle. And I thought, hold on, how can those two things be true at the same time? You can't, it may be a strong consumer, but that doesn't mean it's resilient. Resilience implies it can withstand adverse times. Now, you could argue the consumer withstood really adverse times vis-a-vis interest rates being hiked at an unprecedented level and the highest levels in like 40 years. Sure, fair enough. But if it's running on fumes, you have to question the word resiliency there. A lot of the growth that we've seen, and I actually wrote a Substack about this, I co-authored it with really smart guy, Daniel Dubrovsky, who's a former colleague of mine who you should definitely have on this show. He's really into quantitative analysis when it comes to measuring economic indicators and, you know, all these other sorts of things. And we can talk about that more later. But what we saw was that a lot of the consumption that oh, did it cut out?
You're good. I can hear you.
Oh, okay. Sorry about that. Okay. A lot of the consumption that we saw was driven in large part by excess savings. It was driven by excess savings from the pandemic. So really, it's like, yes, it's a strong consumer, but it was a stimulus-induced consumer that we're now seeing be weighed down. I think it was, I forgot, I think it was QE Infinity that Twitter account put out a tweet saying like, here's where consumer spending excess saving was in August 2021. It was like 4.3 trillion. And then the graph is just like this. It was just going down. And I think now it's at like returning to pre-pandemic levels. And that's why in the first half of this year, we saw a lot of growth. But the Fed itself even said H2 of 2024, we're likely going to see a lot of that consumer strength that we benefited from so much begin to wane. Why? Because of a weakening consumer as a result of the excess savings being depleted, and the effect of interest rates lingering, right? Because interest rates, when you set it, it's not like you see the effect immediately. There's a sustained lag period, and we're seeing that now. So if you combine that with the whole market outlook, you're seeing meme coins reach all-time highs. You're seeing inflation come in higher than expected. You're seeing weaker than expected growth. You're seeing companies like Ted Baker close down and have bankruptcies that just saw, which is like a luxury brand. You're seeing McDonald's, a lower-end fast food restaurant, say we're seeing a cracked consumer, and yet in the market, the S&P is only what, like 0.5% from its all-time highs.
Yep.
You combine that with the precarious narrative you looked at earlier, you're thinking, what's going on here? And I'm not trying to be a macro doomer or anything. And again, the market can stay irrational longer than you can stay solvent. And you want to trade the story, not necessarily the facts. And sometimes they're both the same, sometimes they're not. But I'm seeing all this, and as someone who like trades long term, it does make me a little bit nervous. But that's kind of like what I'm looking at. I know that was a bit of a spiel, but I think these circumstances for me are making me a little bit nervous. And I've already liquidated some of my positions. Obviously, none of this is trading advice. And in some areas I went too soon. I underestimated how long the market could keep going up, and I didn't lose money, but I didn't make as much as I could have. But with me, at a certain point, like when the market reaches a certain level and we're seeing all these meme coins rise, you're seeing the resurgence briefly sort of NFTs, not too much, but a little bit. For me, I saw that and I think this just reeks of market frothiness. And the potential gain that you could get for every level and risk that you incur is just, for me, at this point in time, not very compelling.
No, and I agree. And I sent you a message too in the chat. No, just right now. But no, yeah. When I'm looking at the market, I really see kind of something similar. But it's like you said, sometimes you really have to continue to follow the trend. Like it's the hardest thing to do during certain times, which is like Coco, best example I can give right now. It's one of those, the market got so far away from reality at a certain point. Yes, you could make a million stories of why Coco could have continued. However, there was more stories why it couldn't continue. So when you're looking at something like the market or the S&P 500, sometimes you really have to kind of follow the trends and wait for the real breakdown to happen. Now, once again, if you're a long-term trader, there's many different ways to skin the cat, like we're talking about. If you're a long-term trader like you're looking at value. As you're looking at things like value and so on, you can go, hey, maybe the risk reward here doesn't make sense for me and myself. Me being a trend following trader, like I do it differently where and we might both get out at around the same time. For me, right, I might just, ride the trend. Okay, the trend's turning back down. Okay, that's when I get out. For someone else, it might be, hey, it's strong here. I don't see the risk reward anymore. That's where someone else gets out. You just have to figure out the way you trade. But I think if we're looking at it from a fundamental perspective, I see the same exact thing you're seeing, where it's like the market's been kind of away from reality for years. Let's be honest. Yeah. And if we look at, 2023 is a great example. See this crazy rally in the NASDAQ, and me and the other systematic traders always had the conversation when we got the signal to get long the NASDAQ in 2023. I remember being like, oh my God, are you serious? Like buying the NASDAQ right here, right now, fundamentally, it made no sense. However, sometimes systematically, you have to just take the signals, and we did, and it was correct. However, there was 5, and it turned into 7 stocks holding up the entire market. Now we're kind of seeing some broadening out. I'd like to ask you kind of just to understand a little bit more. If we're looking at the S&P 500, I'm also a person who's like, I don't know about the risk to reward here. But are you seeing any other areas of value in the entire macro space? Like it could be commodities, sectors, energy, copper miners, whatever you're thinking.
So I'm glad, pardon me, I'm glad you mentioned energy, because I think that's going to be a really interesting one. So we saw recently how, and this is like a long-term investment, sort of not cycle, but a long-term investment horizon, and one that is primarily geopolitically driven. So we saw how the Biden administration recently, pardon me, is planning to impose 100% tariffs on Chinese EVs, which is really interesting because, and this is something I've pointed to a lot, this kind of policy, a lot of people seem surprised by it, but in a way I really wasn't, because if you look at what the secular trend is in US politics vis-a-vis China, it's very clear. It's tough on China, and that goes beyond administrations. It goes from Trump to Biden. Trump, was a self-declared tariff man, right? Imposed tariffs on, what was it? Oh my God, what did they pose tariffs on China? There was like $300 billion worth, but it was on it was like washing machines and other sort of, hard goods. And then China obviously retaliated, et cetera. And, what happened then now is that under the Biden administration, now we're seeing tariffs now on EVs. When we also saw trade restrictions on certain semiconductors. This is something I've talked about before, albeit, much more surgical. Trump was, in terms of his tariffs, it was kind of all over the place. It wasn't as surgical, and it was much more market disruptive, which isn't a political statement. It's just objectively speaking, the Biden administration has been more surgical in their approach. But the approach, nonetheless, is the same between the two when it comes to being tough on China and prioritizing economic and political security above everything else. You're also seeing that when it comes to the energy transition, right? You're seeing a lot of these ABC policies, anything but China, take place where, for instance, if you want to get a tax credit under the Inflation Reduction Act, there are certain provisions that kick in that say if it's manufactured in America, then you get that tax credit. If you supply some of your resources, for instance, lithium ion batteries, like the lithium or the cobalt, that has to be done outside of a Chinese supply chain. Otherwise, you don't get access to those credits anymore. You're seeing security take precedent over what is clearly a much more economically efficient option. That, in my view, could have a long-term greenflationary effect. And that's not a term I came up with. That's just been one that's been around for a while.
I like that.
Right. I know. I wish I came up with it. It's a great one. And I think the companies that may benefit from that are mining companies, because you're seeing government-induced demand and supply not meet in time, because it takes the time to set up a mine has doubled from 5 to 10 years. And now you also have a social climate, no pun intended, where you also have to focus on ESG. You have to focus on environmental social governance to ensure that let's say if you're setting up a mine, you're doing it in a green friendly way, which, whatever that means. You have to ensure that you're not, let's say, displacing local indigenous communities, right? All these things take a lot of time, and we can debate the morality of it, but that's not really what I'm concerned with here. I'm more concerned with what's the market impact and what's the impact on commodity prices. And if you see government-induced demand for these EVs and for setting up a much more green economy for this energy transition, but the supply is lagging, that'll create a gap in price. And the IMF and World Bank have put out various scenarios, net zero, sustainable development scenarios, the so-called SDS, over, let's say 10-year periods, 2030, 2040, and 2050. Obviously, the longer time horizon you have, the less the lower the volume of volatility, which makes sense because you have a longer time horizon to implement these semi-structural changes. But even under those circumstances, you do have potential upside, a lot of potential upside for volatility in copper, nickel, lithium, cobalt, a lot of these so-called key transition metals. And in my view, that's in a thematic investment vehicle that I'm looking at. And obviously there's risks, like mining companies, I think, rank as some of the highest, most corrupt industries in the world. And they take place in a lot of countries where there's a lot of structural inequality and a lot of corruption. So naturally it makes sense that as an industry operating there, it gets sucked into that. And there's a lot of geopolitical implications for that too, particularly cobalt. 70% of it is mined in the Congo, which China has a large share of it. So I think that has a greenflationary impact, and I think mining companies are set to benefit from that, because while the Biden administration, Democrats do prioritize the environment more so than their Republican counterparts, ultimately they're pragmatists in my view, and they will yield like they'll yield those ideals to strategy. And I think, but even under those circumstances, I still think mining companies are going to benefit from that huge difference between the demand and the urgency of the near term and the ability to supply it. That gap will then obviously translate to higher commodity prices, from which I believe a lot of these mining companies will benefit from.
No, I agree. I mean, that makes a lot of sense. It's when you're looking at these things, there's just so many different facets of it. And I think that generally right now it's kind of an interesting time, and it's kind of where I'm seeing the inflationary picture kind of come into play. Like, it's kind of the reason why the S&P 500 isn't that appealing to me. It's not something I ever actually trade itself. I usually, if I'm going to buy technology, I'm going to buy tech. If I want to buy the S&P 500, it's so heavily weighted in technology that I don't really see the point in buying it. So it's not really that appealing to me, but there are sectors that have appeal. And like you said, like when we're talking about, I'd say the same thing all the time too, is when we're talking about the, moving to Agenda 2030 and moving off of fossil fuels and stuff. It's not that I want to really talk about my politics about it. That's not my point. It's how does this affect the market? And how I see it affecting the market is that we're going to need a lot of these things to move that direction at all. And as we continue to take some of these things offline, like digging for new oil, whatever it is, as we continue to take these, or even refining companies, they're coming offline. As we continue to do these things, we're going to run into supply issues. We're going to continue to run into things because there's no way to just move off of fossil fuels immediately. Some people don't understand that how much oil is in every car tire or paint or any of these things. There's so much, there's so many things inside of this trade that makes it appealing. And also, no matter what, any way you look at it, things like copper, like things like silver, like you're going to need these things to a huge level. So once again, it's like there's many areas that are very appealing outside of the S&P 500. And so I really think that, the energy idea, the mining idea, these things, once again, like you said, it's a tough trade. And there's so much geopolitical risk out there. If you are buying like a gold miner, for example, you could buy one in Peru or something, and they could be offline in 2 days. Like there's all types of things that have happened that I've seen happen to investors in small gold mining companies. I try to stick to the large cap miners. If I am in any of these mining sectors, I always want to stay large cap. I always want to stay out of these small cap areas. So I think that there's ways to do it. There's ways to invest in it. So what are you thinking area wise then? If you're looking at mining, if you're looking at energy, what's the subsector or sector that you think is a good place to possibly look for some value?
Yeah, definitely. So I agree with you there too. I mean, mining itself is already a very volatile industry. So if you're also trading a small cap in that volatile industry, I mean, you must have a real strong stomach, because that's not easy to endure. So like you, I like the large caps. I mean, off the top of my head, I mean, Glencore is the most obvious candidate. I have to do more company specific analysis about which exposure they have to which commodities. Personally, I really like ETFs. I really, and I've been a big proponent of it. Yeah, like for instance, and I've talked about this before, and for the next show, maybe we can talk about it more in detail. I've talked about it on Wolf Space, like the quantum computing ETF, which has had spectacular returns. I didn't want to invest in any of those individual companies, and I wanted to invest in the trend, and that's what I like about thematic investing. I either invest in a company that's single-handedly leading it. NVIDIA is a great example of that, or an ETF that gives me exposure to the entire industry. So when one company does well and it triggers a rally, and all these other industries that are connected to it, the ETF itself benefits from that wave of innovation. So, with me, I'm a big ETF fan. In terms of the actual tickers, I don't have them on hand. Particularly though, mining companies exposed to, like you said, the transition metals. So cobalt, lithium, copper, those are the most interesting, I think. Copper is an interesting one too, because it's so connected to global growth, especially if you overlay it with oil and macroeconomic trends. It's really interesting because like housing, for instance, uses a lot of copper. That's why, like when China was having its wobbly property market crisis, if memory serves correctly, copper was having a little bit of volatility there, precisely because China is such a huge market. 20% of their GDP is attributed to housing. So naturally, if you saw convulsions there, you would see it reflected in copper prices. As for like sector themes, two areas that I'm going to start looking into and start publishing more is precision healthcare and potentially space. I just authored a 3-part series on the geopolitics of space. And in terms of the investment opportunity, I don't know enough to see if there is something there. It's still pretty what you would call a frontier technology, even though we have it. The key is how do you commercialize it? And by commercialize, I mean bring down costs. Obviously, what do you call it? What's Elon's company's name for, was it X Space or not X Space?
SpaceX.
Thank you. Wow, completely reversed that. Monday morning, I've only had
I do that too. Don't worry. It's Monday.
2 coffees, a lot of X's. But anyways, yeah. So I'm still seeing if that could be a viable investment vehicle. I'm not going to comment on it now because I don't have adequate research to back it up. As a geopolitical topic, it's certainly very interesting. But for that one, if I were to invest in it, my sort of geopolitical tailwind that I would be looking for is, does it have huge security implications, which it seems to, because security now in this current climate is taking precedence over everything else, which then means you're going to see a lot more government funding or a lot more tax credits given to it. You can see that reflected in the Chips and Science Act. Why would we give all of these semiconductor companies so many tax incentives to want to build here? It's because it's very, very, very expensive to build a semiconductor factory. I think if you were to, for instance, domesticate the entire semiconductor supply chain in the US, it would cost $1 trillion and take a decade, right? No private company is going to be like, yes, for national security, let's do that. It's like, no, they're going to say, okay, how do we justify this to our shareholders? The government has to be pragmatic about this. So they're going to create accommodative financing conditions for these private companies to do well and say, okay, this is enough of an incentive for us to do it. The technology is sufficiently developed enough for us to mass commercialize it. So for space, I'm waiting to see how that develops, and that's something that I'll perhaps be writing about in the future. Precision medical care, that's really interesting. I'll talk briefly about it now, and then I'd love to do another episode about it with you more in depth. But there, I mean, the kind of research we're doing, I mean, it's straight out of science fiction. We're now developing drugs that are not, let's say, specific to our genetic group sequences in a broad way, but down to the very specific genetic sequence of who you are. So let's say you and I both have a disease. It's not like they're going to give us a medication. They say, okay, roughly people with this genetic makeup who have this disease will be able to be treated with this drug, and there'll be some outliers. No, we're getting to a point through what's called, I think, pharmacogenomic and pharmacokinetic research to see, okay, how can we tailor a drug to fit Jason Perz's exact DNA sequence to optimize its health benefits? I mean, that's insane. I mean, we're getting medical care personalized down to your genes. There's nothing more fundamental than that. Now, where we are in that, it's unclear. The cancer market is the biggest application, which is rather morbid, unfortunately. But as they expect the market for cancer drugs to grow, so too will the impetus to invest in these very gene-specific drugs. Quantum computing may actually become very interesting, may be very interesting to fit into this equation because of its ability to mass compute data to optimize, let's say, a certain outcome, right? Because your genes and all the variables that entails obviously is a lot for a single computer to handle. But if you combine that with AI and quantum computing, I could see a very compelling investment case to be made there. So you're seeing a lot of frontier technologies being developed that, yes, within their own respective silos are compelling, but between the pollination they have between each other is also a very compelling case study. But anyways, those are other sort of broad thematic investment vehicles I'm looking at. Again, like I said, for space and healthcare, I've researched it a little bit, written about it a little bit, but not enough yet to put my money where my mouth is. But it certainly has, it's whetted my beak, so to speak.
No, I like that because there's, and also for me, I'm also the same way. The ETFs are kind of the easiest way to go. Depends on which type of ETF. Like, obviously, we all know there's some bad ETFs that are built pretty terribly. And also, just as something else I also like to say is I really do like the idea of, if you are investing in ETFs, usually use the large cap ETFs. The reason why ETFs work really well is because they basically take a trend following aspect to it. The bigger a stock gets, the bigger it is in the fund. And so basically wherever you're drawing your performance from, it starts to become a larger and larger piece of that ETF. If you're in a small cap space, and a small cap ETF, for example, you get something that gets very large, they're going to just kick it out of that ETF. It's got to go to the large cap space. So you're basically going to lose out on that performance at some point. So I do like to use that's my reasoning in using the large cap ETFs. So I do like ETFs in general. I think it's the best way to take advantage of a trend, because I'm like you, where it's like I'm not exactly, individual stocks don't really excite me. I'm not someone who's like, oh, I love this individual stock. I want to marry Apple or something. Like for me, it just doesn't mean anything to me. It's not exciting for me. But what's exciting is to really figure out a trend, figure out the macro thesis, figure out where the market's going. And because of that, you can really take advantage of that using the ETFs and being in that space. So I'm glad you pointed to that as well. I think there's so many things in this market right now that are very interesting. And it's interesting you even brought up healthcare, like seeing that healthcare is kind of even catching a bit of a bid. Let me bring up my stuff here. But if we're looking at healthcare and we're going, okay, well, let me look at the sectors. And if I look at healthcare, healthcare has been it's in fourth place over a 1 month time frame. Over a 3 month time frame, it's lagging a bit. But if we look back at healthcare over a half year and 1 year performance, it's starting to catch up. And so I really do wonder here, what exactly is going to happen with healthcare going forward. And something also to know and understand for people like us as macro traders. As a macro trader, when you look at healthcare, you have to also understand that this is one of the high dividend defensive sectors. And so as Dimitri's kind of talking about this market and being a little bit frothy here and trying to position well for certain areas, like healthcare could be one of those areas where there's a bit of a safe haven bid. And most of the time, it's the one that does really well when the market's coming down. Utilities, consumer staples, healthcare, these are kind of great places to kind of hide when the market's possibly in a frothy territory. So let's go back to your list before we get on a rant, because I could rant on that stuff all day. That's fun to me, man. I really enjoy kind of talking about macro themes and where we could end up. But let's talk about the Fed. The Fed. We were going to get on right before Fed Day, or right after Fed Day the other week. But it was
the
kind
day
of
actually.
Yes, it was. Well, we were going to do it the day of, and then I think we moved it around there, and then we came to this, and so it was kind of a nothing burger Fed Day. I'm wondering if you saw anything that you're really looking at and kind of paying attention to here, and why do you think the Fed rate cuts continue to kind of roll the other direction? I mean, I have my own reasons. I'd love to hear yours.
So I'm glad you said that. And while I'm talking, I'm going to pull up this one tweet I put out a while back that I think summarizes some of my views well. So what I'm really glad that the Fed did address is this notion of stagflation, because like I said, we saw that 1.6% GDP print, and then we saw core inflation go higher. So people saw that and their brain just went, slow growth, high inflation, this must be stagflation. And it's like, okay, yes, but no. Because the nuance to that, which I'm trying to pull up now if I can find it, is if you look at where inflation levels were back in the 70s, obviously I was definitely not alive back then, but even just retroactively in terms of the data, and you look at where it is now, it is not nearly as dire. It is not nearly as dire. I mean, my parents lived through it. They had mortgage rates that were over 13%. I mean, like, they were really, really, living through it, but they managed to go through it. It's a bit hyperbolic to say we're experiencing inflation. I mean, stagflation, not inflation, definitely inflation, but not stagflation. I think you need to see a longer trend of that first. If, for instance, we continue to see CPI trade moving either horizontally with a slight tilt to the upside while growth begins to decline, then I would find that more compelling. And I wouldn't wait for a GDP print for that. I think you could look at PMI data. Purchasing Managers Index, for those that don't know, it's an indicator that a reading below 50 indicates contraction, a reading above 50 indicates expansion, and a reading just at 50 is just neutral. And the way I could see this tumbling out is if indeed we begin to see slower growth, you would see that first reflected in manufacturing PMI data. Then you'd see it bleed to services, and then you'd see the composite, which is both of them, decline as well. If you see that combined with higher trends of inflation, I could see that being a legitimate concern for saying, okay, we're beginning to head into this direction, and this is concerning. But just to see it off that one print, or those two prints rather, I think is a bit hyperbolic, and people are a little bit too alarmist to go there. It's not incorrect to say this resembles stagflationary-esque characteristics, but just to call it stagflation, to equate with what we saw in the 70s and 80s, I think is a not very nuanced analysis and deserves more. As for the Fed rate cuts, Powell was interesting, and I always love the memes that come off of that, especially from not Jerome Powell, which is just a gemstone of an account. But anyways, memes aside, in terms of what I was expecting, I mean, like I said, I think any volatility that we would have seen it not from the decision itself, but from the rhetoric, because that's where the uncertainty is. I didn't see anything particularly surprising. I'm trying to think back if he said anything. It was the same thing, rates higher for longer, and we're going to get to 2%. But what is interesting is that the Fed is slowing down the pace of their balance sheet runoffs. I think now it's down to went from like 90 billion now to like 60 or something. I could be completely misquoting those numbers, but I know that they're easing up a little bit with how much they're tightening up the balance sheet. But how about you? I'd love to hear some of your thoughts on that.
Yeah, I mean, so when this year was kind of interesting to me because we had so many people stuck on the fact that we have to cut rates. We just have to cut rates. They're going to come down. And first off, I'll touch on the stagflationary part of it, because that's a good point, because people, one, I use the term too, but people get too stuck in the term thinking it means the same thing as the 70s. Like, we're going to see exactly what happened in the 70s. And it's like, no, we're nowhere near those levels yet. We didn't even see those types of levels in 2020, 2021. Like, we're nowhere near it. Sure, could it happen? Sure, but we're not on path for any of that yet. We'd need to see some major, like, we would need to be in 2-3 years of what we saw once or twice in 2021. And not to mention growth would have to also be down, and all these things moving together, and that's not what we saw at that point. So I do think that we are in a kind of a situation where we could see us moving more into stagflation. But once again, that would also mean the Fed would have to make some mistakes here. And that mistake would have been that rate cut. You know, if they would have started cutting rates, if they cut them 6 times this year, like, absolutely, I wouldn't have even thought twice. I'd have been like, we're going to see 70s hyperinflation, like for sure. I would have felt that way. But they didn't make that mistake. They didn't do what they did, because that's how it happened. That's what the thing a lot of people don't remember, because they don't study that time, and none of us lived through it. But if you go back and you study it like you and I have, you see that there was 3 different waves in there. There was them hiking rates to fight inflation. Then they went, oh, inflation is fixed. Everything's fine. They didn't wait around at all. They didn't pause for a long time like they're doing right now. They just started to cut rates. And as they cut rates, inflation came roaring back, but they continued to cut it in the face of inflation roaring back. This time is different only because, and I hate that phrase, but this time is different, and it's only because they're not sitting here and going, oh, well, you know, we are seeing the inflation. Like, it would have been like them seeing a couple hot prints at the beginning of this year and them going, well, you know, we don't care. We're going to cut because expectations set to. It's just not what they're doing right now. And I'm not saying that they can't. I'm a firm believer that the Fed is usually behind the curve. It's how all of my great trades really come to fruition, is because the Fed is behind the curve. I mean, the 2020, great example. You have Powell saying that inflation is transitory, while inflation continues to tick up, and he's saying it's transitory and everything's fine. And then once it's finally out of control, then he starts to shift. So once again, I can see that this way too, that at some point, maybe they go, hey, you know what, we're going to start cutting anyways. And then I would say, okay, look for some major inflation coming up. Look for some major problems going forward here. But we're just not seeing it. So I agree that we're not seeing that type of environment just yet. As for the Fed cutting, I can't see it. I know there's reasons why I say that it's possible. I see the market is trying to tell me that there's a possibility of some rate cuts here in this year or the end of this year at the latest. And the reason why I say that is because if you look at utility stocks, if you look at consumer staples, they're both hitting 52-week highs. Usually that doesn't happen unless you're in a type of environment that they're going to start cutting rates at some point, or yields are starting to fall, and we're not seeing that yet. So I don't want to front run that as a trader. Like I don't want to front run and go, okay, well, they're obviously going to cut rates because this is happening. I want to see more proof. I want to see more evidence. I want to see a little bit of their language shifting. But what I do see more than anything else is that maybe gold, maybe utilities, maybe they're hinting at something. And what I've been talking about is that we could see a rate cut this year, and the only way I see it happening is if a catalyst happens. So if we see something break, we see the market kind of go into some bad and get in a bad way. We start to see a crash that isn't stopping. We start to see something in the economy. It doesn't have to be market related. It could be just something with a bank or the economy. That would be a reason for them to cut. And I would go, okay, well, they're cutting because of these reasons. Then I would think, okay, well, they could cut. But really, there's no, if they cut, that's really going to bring on so much inflation because it's just sitting under the surface. And they know it. They're not that stupid. Like they see it. We all see it, that it's just kind of inflation is sitting on the surface, ready to roar back at any moment. So if it does ever roar back, we're definitely going to see some crazy times, some crazy inflation, and we are seeing some things under the surface. You know, I'm a commodities trader, and if I'm looking at just at futures, and we go over let me look at performance year to date, and if we look at orange juice, it's up 27% year to date. Coffee up 20% year to date. Oats up almost 20 year to date. Silver up 16%. Oil's up 15%. Crude oil, Brent. So I mean, a lot of these products continue to move higher. Finally, the ags have bottomed. They're starting to break up pretty rapidly. I mean, if we look at just month to date, natural gas is up 20%. Oats are up 15%. This is just for the month to date. Wheat is up 14%. Orange juice is up 11%. Canola is up 8%. So, I mean, it's possible that all of this being under the surface, and if they did even hint at something like a rate cut here, I think they would just explode higher. So I'm hoping they're smart enough to just kind of sit on their hands here. But you never know. It is the Fed. They could all of a sudden just, hey, we got to cut rates for this reason, and then I think it'd be out of control. But for now, like I agree with you, it's just kind of, hey, growth is kind of flatlining. I don't think it's in a downtrend anymore. I have no signals that's telling me it's moving down at the moment. But I just think it's neutral here. Growth's kind of neutral. Inflation is slowly rising, and if it could just stop here, then I think, hey, everything would be okay. But if they cut rates or even hint at cutting rates, it's going to be a problem.
Yeah, and I like what you said there specifically, because also a lot of these assets, like oil, for instance, is denominated in the dollar. So if you have expectations that the Fed's going to cut rates, you know, in terms of just an exchange rate, like, you know, just imagine oil is like a currency rather than a commodity. It'll cost more dollars to buy a barrel of oil. So naturally, then, yeah, I could see how rate cut bets were feeding into that. So then it's interesting. So you're attributing the rising, you could see then a surge in commodity prices higher, let's say based on that dynamic I just outlined vis-a-vis oil and the dollar. You could see that if Fed rate cut bets start being stimulated again, or start being anticipated, or the Fed hints at it or even implements them, that you could see commodities rising based off of that dynamic.
Yeah. So the best thing I ever learned about the Fed was I was hanging out with this older trader. It was when I was working at a prop firm, and I was hanging out with this older trader, and he sat me down. He was like, you know, if the Fed comes in, and let's say the Fed's just says, hey, we're cutting rates from 5% to 0. what would the market do? And I said, well, everything would skyrocket, or maybe just crash, but at some point inflation would go raging out of control. And he's like, yeah, that's all great, but what really changed? Like in a day, like did something change? Were they able to cut rates that quickly? Did that all change? The borrowing rate all of a sudden, did everybody get money for free? Like, did then any of that happen? And I said, no. And he said, well, that's the power of the Fed. It's just what people believe. So as long as it's kind of a belief that they are going to cut rates and they even hint at it, I think that's going to be the problem. I think Powell knows that, and I think that's part of the reason why he keeps coming out and saying things like, hey, we're data dependent, hey, we're waiting. Like I think he knows that if he even hinted at like, hey, I see all those expectations out there, we're thinking about it, don't you guys worry, we're thinking, like even something as small as that, it would send the commodity prices raging. And really, like as I'm looking at it, as I'm trading it, and I'm watching these signals come in. And if anybody is on my service and you're on my Substack, you see the signals where very long commodities. And we weren't long commodities from, I think it was Q1 22 was the last time we were kind of long commodities kind of broadly. And then this year, at the beginning of the year, all of a sudden we're long, oil starts to come in, and then copper, and then, like gold is obviously, raging and making new highs again and again. So I'm seeing all of this movement in the commodity space. And also it's a space that not a lot of traders, analysts are looking at all the time. So I could see us having some very hot prints coming forward. And those hot prints could also manage their expectations a little bit more, which could put a lot more pressure on the S&P 500. So just looking at all that as a whole, just like taking it all, just meshing it together, it's not a good outlook for the Fed to cut rates for me.
Yeah, and I remember that's something we had talked about before. I think on the X Wolf space, I think you and I both brought it up, which is saying that a cut, ironically, under the right circumstances, could actually be a bad thing because because the Fed is saying, you know what, we see sufficient weakness that despite all this rhetoric for higher for longer and really emphasizing that and putting our money where our mouth is, we're going to start cutting rates. That means that markets will see that potentially and go, things must be really bad or about to be really bad for the Fed to do this while inflation has not yet reached their target. So I totally agree there. Also, the reason why I was on my phone earlier, I was looking down, I was trying to find that quote about stagflation, and I wanted to bring it up here really quickly. Like, we all agree, obviously, the recent prints and economic data that we saw isn't ideal. But again, it's nothing close to what we saw. So in 1964, inflation was 1% and unemployment was 5%. 10 years later, inflation would be 12% and unemployment was above 7%. And by the summer of 1980, it was near 14.5% and unemployment was 7.5%. We are not near those rates. That was also during the Great Society program. That was during the Vietnam War, both of which are massive public expenditures. Remember, we only got off of the dollar in 71 with the Nixon shock. So that was a huge macroeconomic adjustment at the time. Our systems, even though we're prone to make the same mistakes, are far more sophisticated now than they were back then, both in terms of our fiscal and our monetary levers that we can exercise. So you also have to look at where core CPI has been and where it was. Core dropped from 9% to, what is it now, 3.8. Now, granted, that's roughly two times still above the Fed's mandate. But you have to remember, right, and I think we've both talked about the same before and used the same analogy. Getting inflation down from high to low in the US context at least, is a lot like losing belly fat and losing fat. It's a lot easier in the beginning when you have a lot of it than when you're trying to shed those last few pounds. It takes way more effort, way more dedication, and way more time. And you're going to have to go through a lot of hurt in order to do it. Inflation is this exact same way. Trying to squeeze out that last bit is always the toughest. And again, because I think people lose track of that picture. It's like, yes, inflation isn't where we want it to be. And I agree, it is annoying, but it has still come down from nearly double digits in a pretty short amount of time. So I think people need to take that into context before they start screaming stagflation. And I'm not saying it's not impossible. I'm saying let's just hit the brakes before we start calling it and start making trade decisions off of it. Because I think that would be, it would be hyperbolic to claim that we're in that stage right now.
No, I agree, and I think you really have to. It's managing expectations as a trader. Like you have
Yeah.
to. One, you have to be very even keeled as a trader to do this well. You can't be a good trader and get to, hey, this is the end of the world. Hey, this is the best trading environment ever. Like there, you can't think in absolutes. You can't speak in absolutes. It's the reason why, like you'll see such a big difference between good traders and good analysts. People love the analysts that can come out and pound in the table, buy this, buy this, buy this. If I did that every day, people would love it whether I'm right or wrong. It's not about being right or wrong. It's the confidence. People love stuff like that. But if you really spend your time with like a Paul Tudor Jones or any of these people, they're paranoid about losing money all the time. They're not confident. They're not overly confident that, if they were, they wouldn't have stop losses. Like, most of the futures traders I've ever been around, the best ones that I've ever been around, they all have stop losses. They all trade very small. They all are completely paranoid about losing money all the time. Actually, their personality is inherently kind of paranoid. And so, like, if you take all of that and put it together, like, you start to just understand, like, you can't be too high or too low as a trader, and you have to always be open to what's hiding behind the corner. And if you're sitting there and going, hey, stagflation, like, you might as well, like, what would I do if I was thinking the market is in stagflation? It's the 70s. Well, I would go put all my money, at as many futures as I could possibly buy in crude oil, and I would sit there for the next 10 years, and I'd probably blow up, honestly. Like, I would blow up at some point by doing that. So you have to be very even. So I like that, you mentioned that it's not possible. It's that you got to take it one step at a time and go, hey, we're here today. Today, I don't see it. Tomorrow, this could happen. And it like we talked about, hey, we could start to see rate cuts. Hey, we could start to see this. And then we would say, okay, yeah, that's possibly coming now. But that's how you trade well. It's steps. So I like that you brought that up.
Yeah, no, I couldn't have said it better myself in exercising that kind of caution. And again, it's not that you can't, it's not like with myself, I haven't played around with individual stocks, like one of my more fun trades that I did just to test out a thesis was I put in, very little capital, but I was like, I'm curious to see if this plays out. It was like into Disney. I saw it was like $80 or $81 a share. And I thought, this seems like a really big discount considering everything that Disney has, its own brand, Pixar, Marvel, Disney. You can argue about the quality. That's not really what I care about. What I would care about is, okay, is this a company oriented around, let's say, putting forward a particular view, or are they fundamentally a corporation looking to increase shareholder value? My bet is on the latter. And surely enough, even though, let's say, the content may not be what people like, and it has been indicating that it's been declining, the share price did recover. Now, is that a function of general market euphoria, or people realizing, hey, Disney has a lot of potential, maybe they can turn this around, increase their viewing rates, get more Disney Plus subscriptions as well as the new parks, it could potentially recover. There's room to make those kinds of trades too. You just kind of want to test out little investment thesis. But you're right, when it comes down to the really big trades in the large portion of your portfolio, you want to exercise data-driven caution and not be susceptible to narratives, but also not be married to your own views. Like, if you see data coming out, like if one of my own investment themes got proven wrong, yeah, it would suck because I thought, this model looks great. It seems to complement the current geopolitical macroeconomic climate. But if it doesn't work and if it's making me lose money, why would I be married to it?
Yep.
Like, no, you just discard it or you modify it and then just go accordingly. It does require a bit of detachment, and you don't want to be on either extreme. You don't want to be a macro doomer Robert Kiyosaki, who I don't understand how that man ever made money with the views that he has. And you also don't want to. Right, it's right. Maybe that's the confidence, right? And then you, on the other hand, have these like these like YOLO. Let's just throw everything at these cryptocurrencies and everything else. Like, it does require a bit of moderation and just sort of meeting in the middle. And look, sometimes I've been guilty of it myself, where I look at the data and I think, oh, this looks unstable, but I have to constantly remind myself, it's like, even if the data is there, what matters is the story, because markets believe the story and they trade off of that, not necessarily what the data says could happen. And that's a constant battle that you have to fight.
I think it's very interesting, and I've been around so many people over the years who they look at trend following trading or price action trading or quantitative trading and they go like, I don't understand how it works. It doesn't make any sense. And it's really that simple fact where it's you don't want. Number one, I feel like something that's always was really important for me to learn and understand is that I don't know where my biggest winners will come from. There's nothing that would have told me in November 2022 that cocoa would have ended up here. There's no model I could have built. There's nothing that would have said, hey, cocoa is going to be your best trade for 2 straight years. That there's no way. However, things like that happen, and it's because you can learn to kind of have an open mind of, hey, because markets trade on stories or markets are forward looking. However you look at it, like there's a bunch of different ways to say the same thing, and people say it differently and they argue about it, but really we're all kind of saying the same thing. That and even the phrase you used earlier, which is the Keynes phrase, markets can stay irrational longer than you could stay solvent. Like, if you understand all of those things, then you understand that as an irrational market, and markets are fully driven by psychology, that they can end up just about anywhere. So because of that, you have to really kind of understand stories behind it, the risk, the reward, use stop losses or position size well or something. All of the great traders, no matter what type of things they do or whatever they traded, the things that you'll see in common are they all had risk management models. They all had position sizing. They'll hear stories of I was telling my one of my clients the other day about the Soros trades and the Druckenmiller trades. Like the be a pig, be greedy like a pig sometimes. And it's like, you guys don't understand when you're running a few $1 billion and you saying be greedy, be a pig. He might be talking about 5% of that fund. Like, he might be talking about a trade that might be 5% of that fund. And most people, would they have like, $10,000 to $100,000 accounts, like you're talking about them taking, they'll take the whole thing. They'll put 100,000 and then leverage and then options, and they'll be like, that's being a pig. And it's like, no, you don't understand. Like there's 2 totally different worlds. And it's only until you kind of get into the world of like where you are a professional trader, you are hanging out with the professionals, then you start to understand, wait a minute, that's not it either. So I think it's good that we brought up a couple of these myths here. We could just end on that. Unless you have anything to add.
No, I think that's a great note to end on.
Cool. All right, man. This is great, Dimitri. We got to do this again.
We absolutely will.
And we'll talk soon. Stick around for a sec.
You got it.